In a significant move to boost demand and the economy, China's central bank unleashed a massive stimulus program. Let's break down the key highlights here. The first is the key interest rate, called the 7-day reverse repurchase rate. This is the rate at which banks can park their excess liquidity with the central bank. Now, this move will motivate banks to lend out to the real economy for better returns. The rate was reduced from 1.7% to 1.5%, with the required reserve ration reduced 0.5%, releasing 1 trillion yuan or $140 billion in liquidity. To support the troubled Chinese property sector, borrowing costs on approximately $5.3 trillion in mortgages will be lowered, and payment requirements for second home buyers will be eased from 25% to 15%. Then comes the central bank, which will provide at least 800 billion yuan or $113 billion in liquidity to support the stock market, and is considering to establish a market stabilization fund. Now, despite these aggressive measures by the central bank, analysts are cautious about China's economy, which is still under a lot of pressure. Recent growth slowed to its worst pace in 5 quarters, raising concerns about reaching the government's growth target of around 5%. Consumer sentiment remains shaky, influenced by layoffs and declining corporate profits. New home prices also recorded their biggest drop in over a decade last month, with fears of ongoing deflationary pressures. There are indications that more aggressive fiscal measures may be needed, especially as local government faces revenue declines. Overall, while the PBOC's actions are designed to stabilize the economy and improve market sentiment, challenges remain in driving consumer demand and effectively managing economic recovery.